2020 has been a historically volatile year for the markets, and it's only fitting that this year pulls into its final quarter with what some argue will be the most tumultuous final weeks of a presidential election in modern times. I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are trained to identify option strategies that can leverage volatile markets and create unique trading situations that can benefit from the market moving in both directions. So if you're interested in an option strategy to use in the upcoming presidential election that can make very good money if the market sells off after the election, and the possibility to make a huge amount of money if the market rallies after the election, then stick around because it's pretty interesting. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so with the election about a month away, we're pretty sure to see some radical moves in the market, particularly as polls come out, debates are held, and the campaign in general heats up. And so there's an option strategy known as the diagonal that can behave in very interesting ways around elections. So it's always a good idea as an options trader to take a look into the past to provide idea generation for trades that could be made in a similar circumstance. So in this video, I wanted to show you an example of a diagonal trade for the 2016 presidential election to show you how this all sets up. So let's first take a look at the Russell 2000 index of small cap stocks about a month before the last election in early October 2016. And as you can see, the index was trading up around the 1250 area. And so suppose that your trading thesis was that until the election was resolved, the market was unlikely to make a big move up, presumably in relief about the outcome, or for that matter, down very much, because according to the polls, the election was a fairly close one, and most market participants would rather wait for the outcome of the election before placing their bets. And so an astute options trader back then could have considered a call diagonal trade on index options of the Russell 2000 index. Now, before we get into how this trade works, I wanted to make sure that all of you are familiar with how index options work. If you are, just hang with me for a minute. This will be quick. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the Russell 2000. You can't really buy or sell 100 shares of an index, but what you can do is to get paid in cash $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if the RUT index is trading at 1350 and you buy the 1360 call, if the index closes at 1365, you'd receive $500 in cash in your account. If the index closes at 1360 or lower, on the other hand, your call would expire worthless. On the downside of the market, if you buy a 1335 put and the market sells off to 1325, you'd make $1,000. But if the market just sold off to 1335 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will also allow you to put together combinations of options, in other words, option strategies that involve both short and long options, purchased in a way that's advantageous to you as a trader. Okay, so now that said, let's take a look at a trade that we could have put on in early October of 2016, having no idea how the election was going to come out at that stage. All we knew was that most market commentators felt that the market would rally if Hillary Clinton was elected and sell off if Donald Trump was elected, which kind of shows you how much the commentators know and how seriously your trading should be based upon their predictions. But that's a discussion for another video. So if you wanted to put on a trade with the thesis that the market is unlikely to move too far upwards until the election's outcome was resolved, then you could have placed this options trade known as a call diagonal spread. So with this particular call diagonal spread, we would sell 10 of those 1270 calls expiring a few days before the election in October, and then we move to the November 30 options chain, which expires about 4 weeks after the election, and buy 10 of those 1310 calls. That combination is called a diagonal call spread, and it's a strategy that experienced options traders can employ in situations like this. So the thinking here is that with the election coming up in about a month and the uncertainty surrounding it, that the market is unlikely to make a big move up or down until the election's held. By selling this particular combination of options, though, we've put ourselves into a really interesting position that we'll explain to you in a minute. But before we get into that, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. And so if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. You can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so let's take a look at the cash flow implications of this trade before we run through how it plays out. So now first off, we sell those October 1270 calls for $10.20, but remember, those represent $100 per point above 1270. So we multiply that by 100, and we sold 10 of those. So you multiply the entire cash flow by 10 to arrive at the total cash received from selling those calls, which is $10,200. But we then turn around and spend $6,200 of that for those November calls farther up the options chain for a cost of $6,200 for all 10, as you can see from the calculation. So the initial transaction created a credit, an inflow of cash into our account of $4,000. Your broker will require you to have $36,000 in your account for this transaction, incidentally, which is also the worst case scenario loss for the trade. Now, keep the fact that we received a $4,000 credit for this trade initially in mind as we move forward to a few days before the election. And as you can see, the Russell 2000 has sold off down to 1163, and thus the October calls that were short have expired worthless. As the market approached the election, anxiety increased and the market sold off in that uncertainty. Now, that sell-off also caused the November calls to lose a lot of value as well. But those are still alive and will be trading for another 27 days. And you see there's some potential for a bounce within those 27 days, so those calls will have some value, although at this point, very little. Now, this is pretty significant, as you're about to see, because let's think about what's happened here. The entire transaction brought in $4,000, like we mentioned earlier, and the October short calls have now expired worthless. The November long calls have lost most of their value also, but still are worth $240, and thus the full trade has a current P&L of $42.40. So what are the implications of this? Well, there are really two very important ones. The first is that we're now guaranteed a profit on the trade of at least $4,000. Why? Well, even if the market sells off after the election and the November calls that were long expire worthless, we would have still collected that $4,000 originally. But there is potentially far more money to be made because those calls are still going to be traded until that last day in November, and so they still have an opportunity to have some value. So now, continuing the story of this trade, you'll remember that after the election, Contrary to what the talking head said, there actually was a substantial bounce in the market after the Trump election, and a particularly pronounced one with small cap stocks that are the components of the Russell 2000 index. And so by November 25th, the value of those calls that we still owned had exploded, as you can see, to $39.12 as the RUT had rallied all the way up to $13.47, 37 points beyond the strike price of those call options. With 6 days to go on this trade, it does make sense to close the trade at this point. And so let's take a look at the final valuation. And as you can see, in addition to the initial cash flow of $4,000 on the trade, those November calls that we are long, because we held on to those, securing our minimum $4,000 gain, appreciated explosively as the RUT rallied, giving us a huge win on top of the guaranteed $4,000 profit no matter what. The final win of over $43,000, which against your broker's required capital would have been 119% in under 2 months, is obviously extraordinary. So what I'd like you to take away from this video is that with option spreads, if you have a thesis like this trader did, that the market will not rally until after the election clarifies, then you could set up a trade where there's literally no downside risk, because if the market did in fact sell off after the election, those November long calls would have simply expired worthless, but you still would have made the original $4,000 cash flow, because only those short October calls expired worthless. And at that point, there was only upside potential left in the trade. So interestingly, by the sell-off occurring first, followed by the rally, the trade made money initially from the sell-off because it allowed the October short calls to expire worthless, making the trade risk-free at that point. Then with the explosive rally, the long calls ended up appreciating tremendously, which was a bonus. And in fact, that bonus ended up being very, very profitable. So the trade actually made money from both the downward movement and the upward movement, because the short-dated short part of the trade expired first, while the longer-dated long part of the trade expired 4 weeks later, taking advantage of the rally. The truth is, if you think about it, the trade from the beginning never had any downside risk. The only risk, in fact, was if the market rallied first before the short calls expired, and depending on how far they rallied at first, a loss could have occurred. But if the rally was modest, even in that scenario, a modest win would have been possible as well. But that's a subject for another video. For now, though, the important thing to realize is that professional options traders are able to creatively design trades around their market thesis. And if they're correct, the results can be seriously profitable, as you saw in this case. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss any of the free trading videos that we're posting constantly on our channel to help you to improve your game as a trader.